And we are live. Good afternoon mga kapidax and welcome to our weekly webinar. No? I'm your host Kyle, and today is a very special edition of our webinars because it's not just our weekly roundup where we talk about just the news. We are joined by our friends from Open Journal, and I'll be introducing them in a bit. But just before we start, comment naman tayo dyan. If you are from Open Journal or you are just a organic Kapidax member, comment naman kayo, say hello, because this episode will be very value adding, no? And lots to be learned here, no? And I hope you guys really make the most out of it and listen to the insights being presented by the speakers. Before we get started and bring them to the stage, I'll just share my own web wares rin naman, no? So if this is your first time watching, welcome, no? And the views and opinions that are expressed in this webinar are only that of the presenters. They do not necessarily reflect the company's views. The statements being made are not to be treated as investment or financial advice. Please exercise caution when buying and selling cryptocurrencies as they are highly volatile. So if this is your first time watching us, welcome. PDAX is a BSP licensed digital asset exchange that allows Filipinos to buy and sell digital assets such as Bitcoin, XRP, Ether, Tether, Bitcoin Cash, Litecoin, and more. Soon to come, syempre. But yeah, and I'll just make this quick, no? If you saw earlier this week, we had the launch of our campaign called Start with PDAX, hashtag Start with PDAX, where we unveiled the pro mode on our app where you can now see a live order book that you can access and trade from your phone without having to switch from looking at our web app to see how thick, how deep is our order book at the moment. No, you can just go to our app and access order books from there. There are also other upgrades such as faster KYC, being able to purchase for as low as 50 pesos and more. And this is really just the start of our continued effort to bring more updates and improvements to the PDAX app and to improve your trading journey with us as well. So we also unveiled a giveaway. So from May 25 to June 7, we have a huge giveaway, no? Every completed trade will merit a raffle entry. Wow, anong raffle entry? Where you can trade like a pro. So we understand that everyone wants to become a pro in their own right. So we have 3 prizes up for grabs. No, we have Play Like a Pro, where we're giving away a gaming bundle, a Predator laptop, headset, keyboard, mouse, tsaka gaming chair. So if you want to be a gamer, a pro gamer, this is the perfect opportunity for you to play like a pro. Meron Draw Like a Pro, an iPad Pro, along with an Apple Pencil to help you sketch and draw your desired art. Maka NFTs tayo dyan. And finally, Vlog Like a Pro, right? With digital media being more influential, why don't you become an influencer or become a YouTube star and have a Canon G7X Mark II along with microphone, tripod, and ring light to help you start vlogging and get you started to become your own vlogger in the future. No? So, and finally, today we also unveiled that you can now cash in via GrabPay. It's instant with through our friends from PayMongo who enabled this GrabPay integration. Fee is just 25 pesos, real time up to 50K. You can cash in up to 50K per time, per beses. Sorry, but may konyo pa pala, sorry. But yeah, and syempre, we unveiled 2 good news. Just a small heads up lang. We informed everyone that we'll be having a 2-hour, sorry, not a 3-hour, but 2-hour system maintenance right now from 5:30 p.m. to 7:30 p.m. No? So both the PDAX exchange and the mobile app will be unavailable while the maintenance is ongoing. Kaya dito na lang kayo, di ba? Watch and learn from the best. And just stay here na lang and spend your webinar spend your Friday night watching this webinar while waiting for our maintenance to finish. Right. So with that being said, I will now be introducing our speakers. Our speakers are none other than Javi Medina and Joseph Singson. Welcome, guys. Thank you for coming. Hi, Javi. Hi, Joseph.
Thanks for
What's
having us, Kyle.
Yun. Great. Thank you also for joining us. And I'm really excited to listen to what you have for us now. It's been a crazy couple of weeks this month of May, and I'm sure maraming updates dito na you can share with us. Yeah, I'll just share the screen. I'll be giving the floor to you. So, yeah.
right? Thanks, Kyle. Just checking if you can all see my screen. Is it good?
Yep, I think you can. I think
Awesome,
we
awesome.
can.
Great. What's up, mga kapidax? Everyone, good afternoon. TGIF. I hope you all had a good week. And let's cap your work week with our crypto convos. Crypto conversations with We Open Journal in partnership with PDAX. And we're all hoping you guys are excited. But before that, guys, can you please comment in the chat section, G na G, if you guys are ready to begin? So I don't want to make this take any longer, and I'm sure you guys are excited with what we'll be sharing today. Rest assured, it's going to be value adding and something that can help you improve your trade plan and really navigate and ascertain with a higher level of confidence how to maneuver this volatile market. So, with that, Habs and I from Open Journal are going to be sharing with you some pertinent updates as well as the road ahead. G na G, madami pong nagko-comment and I know you guys are excited. So without further ado, let's begin. Again, good afternoon to everyone and let's go. So, we need to take a step back, guys, a bit of a breather. Madami pong nangyari this week. The past few days, we saw volatility, and I think volatility is even an understatement with those scary moves we saw across the board in the cryptocurrency market. But as a frame of mind and beginning in the end in mind, I think we need to really understand what has been happening. And we really need to understand that the prices we see with cryptocurrency, though they're happening in the present, are really trying to price something in the future. One of the most popular American investors and hedge fund managers, Stanley Druckenmiller, he talked about how there needs to be an understanding and visualization of the situation, not what's happening today, but what might happen 6, 12, and maybe even 18 months down the line, even though that's the price action we're seeing today. And we also have to take a step back and understand that technical analysis, which is your study of price, is really a leading indicator compared to fundamentals or what's happening within that company as of today, and even sentiment, what the quote unquote crowd or majority are feeling, and what a lot of these emotions and decisions are trying to say. So, in order to really understand what's happening today, we need to have an open mind and visualize what the possibilities might be down the line to be able to make the most informed and astute investment decision. But before we understand what really happened from a probabilistic point of view, let's talk first about what the crowd or majority of people think happened. Because sometimes, guys, in the financial markets, we need to be able to differentiate between signal and noise. In an environment where 80, 85, 90% of people lose money in the long term trading cryptocurrency and different financial asset classes, it's also safe to assume that the similar demographic of ideas, of crypto picks, of shills, of altcoins, of trading ideas, of stories, of narratives could likely also lead to losing money. So, what did we hear? We essentially saw news and sentiment of a lot of different things. You had Tesla saying that they will no longer accept Bitcoin as a point of payment or incorporating it into their balance sheet. You saw Elon tweeting a plethora of different things, some of them being more bullish, some being more bearish. He even tweeted something about having diamond hands. We saw a lot of noise about the China ban, which we have to understand is something that's quite relevant and might be a headwind in the future. But this is nothing really new, especially in China where ICOs are banned and all of those particular things regarding crypto. But to clarify, people can still freely hold it. Do they choose to do so through a certain exchange? And to a large extent, a lot of these things felt like manufactured FUD or fear, uncertainty, and doubt. Which is why we have to understand that there's a huge difference between correlation and causation. Don't get me wrong, the aforementioned points I mentioned might be related to an extent with that cryptocurrency sell off. It could be a contributing factor, but it likely is not the root cause from a probabilistic point of view. Let's take a step back and really take a look at the reality of the situation and what happened as we shift away from speculation and misconception and really try and understand the hard, cold truths of what really happened. Needless to say that it was a scary sell off. Our majors, so Bitcoin and Ethereum, went on a low within that range of over 40%, and even some altcoins and tokens fell over 70%. I'm sure at that time, guys, if may mga hawak po kayo, it would be largely concerning. You would be protecting profits or cutting losses at that time. But we have to understand that this was triggered by a lot of accounts on margin and trading with leverage who were liquidated and essentially wiped out. And this resulted in a lot of lost US dollars with retail traders and speculators. It's a very unfortunate situation, especially those who take on a high degree of risk in the form of leverage, which is why we just want to echo the leverage being a double edged sword. And this has to be used vigilantly and responsibility. At least professionally as our team and within our open journal community, we don't advocate the use of leverage given that unnecessary risk and given that it's not something under our forte or area of expertise. So what we really saw was a crypto stress test across the board. But we have some good news. And this is something that thought leadership and pundits like Raul Pal of Real Vision and Willy Woo also echoed. No firms really went bankrupt or under. There was no need for some sort of Fed or central agency to step in, given the gravity of what happened. Decentralized finance did not dissipate or break or go away. No particular protocols failed. And there were no large firms that needed dole out or some sort of rapid funding. As unfortunate as it is, what we really saw are retail speculators losing money, but the system in and of itself remained intact. It was a stress test, a very stressful one at that, but it did not break. So, we need to take a look at what triggered this particular sell off. We saw spot exchange net flows. If you look at the lower portion of the graph, as prices went lower, we saw exchange inflows. What this simply means is people were transferring from their cold wallets or cold storage onto the exchanges, likely with the intention to sell, protect their profits, or cut some losses to that fact. But we have to understand and take a look at who of that demographic was really selling. So the simple answer is really the whales were selling. Whales are categorized by those who have 1,000 Bitcoin and above in their wallet. And then the medium demographic are dolphins and sharks who have between 100 Bitcoin to 1,000 Bitcoin. But I'm sure marami po tayo dito, we are part of the shrimp demographic. It's just not here in the slide, but the shrimp demographic of retail traders are those who have less than one Bitcoin in their particular wallets or exchanges that they're using to transact. So what we simply saw here was as larger accounts or whales were selling, you had an influx of unique addresses and people creating accounts through the different on-ramps of liquidity. And these shrimp were really buying that dip, quote unquote, and accumulating their balance and position. So now it's clear what triggered that sell-off and how a lot of it was predominantly retail who were affected negatively. The question you guys are all asking is, Joseph, Javi, Open Journal, PDAX, what will happen next? And I essentially have both good and bad news for you, generally speaking. So the good news is, from a technical cycle analysis through our discipline of Elliott wave, we would like to believe that we are facing or we're at the cusp of a major correction, although still part of a larger uptrend. I'll say that again. We are in a major correction inside a larger term uptrend. And please don't get me wrong. I'm not saying you blindly buy this and deploy. You really need to be able to follow your own system. Whether you're a longer term investor and you're doing some sort of dollar cost averaging, or you're an active tactical trader riding the fastest horses and trading those particular swings of relative strength, it's really important to plan your trade and trade your plan. The sort of bad news regarding this consolidation period is that it might take some time. To those of you familiar with Elliott wave and cycle analysis, the wave 4, where we argue we're at now, is likely similar in terms of time duration as your wave 2, and this potentially could extend maybe around 30 weeks or even a period of 6 months. So essentially, the good news is that, at least from a probabilistic point of view, looking at macro and looking at price, this is something that can still go higher over the long term. But in the interim, we do expect pockets of volatility and a certain sideways consolidation given the technical damage done over the past 2 weeks. And I think the most important thing here, which we can learn from these 2 weeks of volatility, are just two things. Number one, the volatility of cryptocurrency markets across the board, it's definitely an understatement. And to those of you who haven't experienced investing with other traditional financial asset classes like debt instruments like bonds, T-bills, or time deposits, money market, or equities, we're really jumping at the deep end of the pool in this spectrum of financial asset classes where we have the most volatility. And the second thing in relation to volatility is really the importance of risk management and honoring your stops, whether that be using a trailing stop when you protect your profits, or whether you use a point to protect your portfolio, your capital preservation, when you use a stop loss to be able to prevent a stage 1 tumor in your portfolio from becoming a stage 4 cancer. And with that, I'll turn over the next portion of the presentation to my colleague and associate from Open Journal, Javi Medina, to continue and go deeper on this thesis and shed more light on what's been happening. Javi, go ahead.
Thank you so much, Joseph, and awesome job for the last few slides. Can you hear me clearly? Just
All
a
good,
sound check.
man.
Right, so good afternoon, everyone, and welcome to today's presentation. I just wanted to come in and echo pretty much what Joseph has already said so far. And the first point I'd like to echo that Joseph made is that at least to center everybody on the proper time horizon, we still believe, and not just believe, but based on the analysis that we do, in Open Journal, not just Open Journal and BIM, we don't just do a lot of work on Elliott Wave, we do a lot of work on-chain analytics, stock to flow, and even analogs from the 2013 and 2017 bull market. And based on what we've found, we still believe that this market still resolves higher over the long run. And this is precisely why that even within the last 2 weeks, despite the volatility that we saw, we have found even new luminaries, big names and big investors such as Ray Dalio and even Carl Icahn, right? I think it was just yesterday that Carl Icahn, famed investor, hedge fund manager, announced that he'll be allocating $1 billion at least to the cryptocurrency markets. So what I'd like to do is to show you some charts that support that long-term picture. So the first chart I'd like to show you, Joseph, if we can just move to that slide. First chart I'd like to show you is essentially the total addressable market for the king of cryptocurrencies, which essentially is Bitcoin. And, Bitcoin this week, past 2 weeks, took a beating from a total market cap of maybe more than $1 trillion. It's now down to 700 billion. And what I'd like to show here is essentially the long-term potential for Bitcoin. Because I know everybody here in crypto is pretty much here to speculate and to make money. But let's go back to the simple reason why as to Bitcoin and cryptocurrency markets are moving higher. The simple reason for it is because Bitcoin and other cryptocurrencies are really there to solve a simple problem, right? And that problem is really the outdated and the problematic financial infrastructure that we have. It's a financial infrastructure that has a lot of dark clouds over it. I won't go into that in much detail, but there are a lot of question marks with respect to the central planning financial system that we have now, especially with all the money that's being printed and the ramifications of that, the knock-on effects on that, not just, let's say, on the dollar as the reserve status. We had Joseph alluded to Stan Druckenmiller. Stan Druckenmiller just this weekend came on, I believe, the University of South Carolina graduation speech. And for the first time ever, he pretty much went on record and said that he really believes that over the next 15 years, we will see the dollar lose its reserve status as the currency. And obviously he says that he doesn't really know what the replacement is going to be for that financial structure, but his biggest bet is that it's going to be the cryptocurrency blockchain space. So with that said, let's go back to Bitcoin and let's see what Bitcoin is really trying to do. So Bitcoin is currently 700 billion. And the reason why a lot of money is flowing into it is because there are several use cases that Bitcoin can really assimilate itself to, which suggests a larger price or a higher price down the road. And the one thing I'd like to highlight here is the red circle, meaning the one with gold, which is a 5 trillion market. Gold really is a 10 trillion market, but if you really take out jewelry, if you take out central bank reserves, because we're going to assume that central banks will never adopt Bitcoin in onto their reserves. So the net level of that is around 5 trillion. And what everybody believes to be the lowest hanging fruit use case or the longest or the long-term potential of Bitcoin is that they believe it can serve the same value or use case as what gold has for the past 5,000 years. So there's still a lot of potential in terms of Bitcoin growing to be able to capture some of that market. And it's not just luminaries who believe this. Even the largest, most important people in the financial system have already expressed this. If you look at the central bank governor of the States, Federal Reserve, Jerome Powell, he's pretty much gone on record and said that he doesn't believe that Bitcoin is really a medium of exchange or a currency, but rather a store of value. This was back in March. And around last month, you had the vice governor of the People's Bank of China come on record and say that he believes that Bitcoin is really there to really overtake gold as a store of value, right? And I think that's really the potential use case. And that's just one use case of Bitcoin. If you talk about Bitcoin as being, let's say, a currency that you can use to buy a Tesla, which Elon Musk discontinued, or let's say, let's just not even talk about Tesla. Let's talk about in the first world where you go, a lot of these merchants, PayPal and all these other financial service firms are already accepting Bitcoin as a form of exchange, right, to transact value. And those are just use cases that, let's say, settle here in the global M2 space, the 110 trillion. You have the global digital payments over here. So I think from a fundamental point of view, a lot of people are still using this correction, this volatility to buy Bitcoin on the dip because of the long-term potential. And the purpose is to show this is because what we want to do is that we want to be able to combine all our different analysis, Elliott wave, fundamental analysis, technical analysis, so that we can stay on the right side of the trend. And so far, although we are seeing a lot of volatility, even as we do this presentation, long term, we still think that this market resolves higher, right? So maybe we can go to the next slide and look at the total addressable market for Ethereum, right? So for those of you here who aren't familiar with how Bitcoin is different with Ethereum, those are essentially two different things. And what I have here is a chart by Arthur Hayes, owner of BitMEX, and one of the luminaries in the space. And he has this is a chart that you can find on his personal blog. And what he explains there is how Ethereum is essentially very different from Bitcoin. If Bitcoin is really trying to solve the store of value problem or the hedge against inflation problem, what Ethereum is really trying to do is really trying to solve, or it's really trying to displace a lot of the financial primitives that we have in the system. What do I mean by financial primitives? Financial primitives are basically all the financial services that we see every day, such as lending, such as, let's say, time deposits or SD accounts, such as, let's say, insurance, such as, let's say, exchanges, right? Financial firms that help support the financial plumbing on the system. And if you look at what Ethereum really is really it's like a platform where a lot of protocols can be built that will essentially be competing with the traditional financial primitives in the system, right? Except that it's decentralized and transparent and it's on blockchain where you can absolutely trust the system. So just to give you an idea, if you look at some of the protocols built on the Ethereum platform, take for example, Aave, right? Aave is a protocol that's aimed to replace lending, right? So it's a protocol that's aimed to replace lending, which essentially, instead of getting a loan for, let's say, 3 months, where you have to submit certain documents based on FICO scores and ITRs, wherever jurisdiction you are. For Aave, you can simply get a loan in less than 5 minutes, right? And that's just Aave. That's just one of 4,600 plus protocols that are being built on the Ethereum platform, right? And you have other protocols such as, let's say, Injective Protocol, which is meant to be a Robinhood version on top of the base layer protocol. You have Uniswap, which is intended to replace firms such as, let's say, Coinbase, right? You have AppNexus, which is supposed to be a use case on insurance, and so on and so forth. So essentially, if you look at Ethereum, what Ethereum is really trying to do is that it is essentially the face of DeFi, or decentralized finance, which essentially is trying to come on board and replace the current traditional financial system, which is centralized finance. Centralized being central banks at the center of the financial system. And what this chart shows is the first column. It shows what percentage. It shows, let's say, the percentage. What this table essentially shows is the value of Ethereum if, let's say, it can get at least 0.1% of the total market share of the traditional financial system. So take, for example, the bottom row as an example to illustrate if Ethereum as a DeFi and NFT platform, if Ethereum as a decentralized finance platform is able to get at least 0.1% of the traditional centralized financial market, then those revenues are equivalent to around 2.7 billion. So assuming it gets 0.1% market share, that would translate to a Ethereum price of around 4,000 per coin. If it takes at least, let's say, this third row from the bottom, if Ethereum is able to, let's say, get 1% of the total market share, which we think is very easy in our, at least over the long term, given everything that's being built, given all the talents moving to that space, given the size of the growth. If it's able to get 1% of the total market share of the current financial system, that's equivalent to around 27 billion in revenue, which is, let's say, equivalent to around 40,000 per coin for Ethereum. So that's essentially looking at Ethereum from a total addressable market, from at least the potential that Ethereum can be over the long term. And when we say long term, 6, 12, 18 months, right? So that's essentially what's happening with Ethereum. If you look at the DeFi space is essentially growing at one of the highest clips that you can see. If you look at, and the reason why I say that is because if you look at the DeFi space now, at the end of 2020 last year, the total value locked in, or at least the total value that was in the DeFi space was around $1 billion. And today, right before the crash, that was around $140 billion, right? And just to give you an idea as to how fast that growth is, that's a growth of around 120, 130% per year since, let's say, Ethereum started in somewhere in the half of this decade, somewhere in the half of the last decade, right? So it was growing around 120, 130%. And just to benchmark, if you look at the peak of internet adoption growth, that was back in the mid-90s. The internet, in terms of users, was growing at a peak of around 63% per year. Today, if you look at the number of unique addresses, at least on the Ethereum network, that is growing at around 113% per year, which is growing at double the size of the internet during its peak. So that's at least what we're seeing for Ethereum and the long-term potential, and why we still think that the market's going to go higher. And wave aside, technical analysis aside, we still think that just looking at the evidence, right, of just looking at the evidence, everything still points to higher prices, at least in the months down the road. So maybe we can move on to the next slide after Ethereum. I do agree with what Joseph said. I do echo what I do like to echo with what Joseph said is that yes, the good news is that we'll be higher in the long run. The bad news is that not really the bad news, but just to manage people's expectations. I think what people need to expect is that we are likely in a prolonged sideways period. In Elliott wave terms, Joseph hit correctly. It's what we call a wave four, right? In the cycle. And cycle pretty much goes 1, 2, 3, 4, 5 going up, 1, 3, 5 being bull markets higher, and wave two and wave four being corrections in the middle of that bull market. So we are in the correction labeled wave four. That's where we think we are from a probabilistic point of view. And if you look at how historically wave fours work, wave fours typically stay above certain key levels. For those of you Elliott wave geeks, these are the 236 and the 382 fib levels, depending on how strong the security is. And for Bitcoin, this corresponds to the 30,000 and the 22,000 level. So obviously right now, it seems like prices are holding above the 33,000, which is where a sideways pattern can develop, maybe a triangle, maybe a sideways, just a sideways base or a sideways box to keep it simple. But it still remains to be seen whether we hold above the 33,000 or do we get a more larger sideways drop, a larger sideways range that takes it all the way down to around 22,000. So this is a chart essentially by Trading Analysis, who pretty much shares the same count that we have. And I think the other bad news that maybe we're seeing is that if you're a hardcore Elliottician, then you know that waves 2 and 4, according to Elliott wave literature, tend towards equality in time. What do I mean by that? It means that if you look at these two circles over here in front of you, it means that you can actually, if you track wave 2s and 4s all throughout history, not just in crypto, but in financial markets, you learn that there's a time relationship between the two. And they tend towards equality, yes, meaning 1:1. But sometimes wave 4 can be even longer than wave 2 to a degree of 1.618 or 1.382. So what we'd like to say is that if you look at the first circle here to your left, if that circle was around 37 months, 37 weeks. So 37 weeks is what, 9 months, right? So if the first circle was around 9 months, then this particular correction that we're in will probably last 9 months or even more as well. So I'm not trying to make a forecast. Please don't get me wrong. But what I'm trying to do is just to share with you how we're thinking about markets from a major probabilistic point of view. So given that this particular move that we're in is probably going to last a few months, then the question is, do I, take a vacation for 9 months and just come back and participate in the next bull market? No. And the simple reason for that is if you look at what we learned from, let's say, guys like Mark Minervini, even inside a major consolidation like this, which has a wide range, you will learn that the leaders in the crypto space will already emerge while Bitcoin is halfway through its consolidation. What I'm trying to say is, even if, let's say, Bitcoin is, even if, it consolidates for 36 months, even on the second quarter of that correction or consolidation, you're already going to see leaders emerge from the crypto space, right? Whether it's promising projects like Thorchain or Polygon, or let's say other crypto issues like, for example, UMA or Kava, then, or even, let's say, some of the basic financial primitives like Aave or Compound or Chainlink, right? That have large use cases. What we are watching out for is to see who the leaders are, because the leaders are essentially going to be the securities or the cryptos where traders, assuming they're able to hold on through that uptrend, it's where traders will make the most money versus the laggards in the upcoming bull market over the next few months. And these leaders are pretty much going to start to lead the bull market weeks and even months before Bitcoin finishes the consolidation. So that's essentially how we're thinking about the space, right? And I do want to make some other points during this slide. And even if you're not, let's say, into Elliott Wave, even as a classical technician or someone who's just into charts, it is pretty much common sense to expect some sideways consolidation from here, given the technical damage that was done during the sell-off. And when I say technical damage, remember that was a 42% drop in market cap in the space, right? Which means that even Bitcoin, which fell the least, pretty much fell by around 1/3 of the value, or from high to the low, pretty much 50% of the value. And when you have a security that drops 50% in 2 weeks, marami dyan naipit na hodlers or people who just who bought late into the uptrend, right? And because maraming naipit sa drop, it just makes sense that on the way up, mas marami kang kalaban na sellers, because not only are you gonna encounter sellers who are profit takers, those who bought the lower, close to the low, bought the 236 support, but kalaban mo rin yung mga sellers na naipit who just want to get out, right? Or who want to get out at a small loss. And because of that damage that needs to be digested, that demographic pretty much that needs to be digested, where you need a transition from weak hands towards strong hands, that is essentially the spirit of the pattern that may be unfolding over the next few months, a sideways pattern where we need to undergo some form of indigestion before weak hands turn into strong hands. And once that we cross the tipping point, then we're now ready for the next bull market, which in our opinion, we really think that this market over the next 18, 24 months can still go to around as high as 75,000 to maybe 186,000, at least for Bitcoin. So let's maybe move on to the next slide. And perhaps one of the things that I like to point out is Joseph mentioned something very important a while ago, and he said that markets are not a reflection of what exactly is happening today, but they're a reflection of what is unfolding within the next 6, 12, 18 months, right? If you're an investor, whether it's stock market or cryptocurrency, if you want to explain to a 2-year-old kid what you are essentially doing, is that you're essentially trying to predict the future. That's all we're trying to do, right? Every time you make a bet, whether it's Bitcoin, Ethereum, some of you traders bought Roblox or Palantir or gold this week, which looked like they broke out. All you're simply doing is making a bet that in 6 months or whatever days, weeks down the road, prices are going to be much higher. That's all we're doing. We're trying to predict the future. And that's essentially what we do with investing or trading. We're trying to skate where the puck is going. And Joseph made a very good point that the drop in prices that happened this week, it's always easy to point to something that's happening today, like the China ban on miners, or the Elon Musk tweets, or other FUD that came out. But the reality is that markets are always a reflection of what's more of down the road. And the news are always going to point to what's happening today. And the truth is the correlation is not always causation. So what we'd like to do is point out what exactly does the team Open Journal or BIM see in 6, 12, 18 months down the road. And we're going to try to take a stab at it with the next 2 slides. And the first slide I'd like to show you is Bitcoin overlaid with the global equity index. And I wasn't able to place it here, but this is a chart originally by Larry McDonald of the Bear Tax Report. And what he pointed out over here is that over the past 5 years, Bitcoin pretty much has been a very good leading indicator of global equities, right? You'll see here in 2018, it peaked a few weeks before global equities in early 2018. It bottomed pretty much a few weeks before global equities in December 2018. That was the last bear market bottom that we had prior to the COVID March bottom. And also, it bottomed a few days before equities in March 2020 during the COVID bottom. And now it's rolling over this Q3 2021. So, I'm sure you guys already know by now that Bitcoin and cryptocurrency is highly, highly correlated to the equity space. It's highly correlated to the risk on trade, right? So when the team saw this chart, me, Joseph, and Matt, and the other team members, we asked ourselves, wait a minute, if Bitcoin is a leading indicator of global equities, then since we're equity guys originally, are there any red flags that we are currently seeing in the equity market right now as of this point, which are also leading indicators of risk on, risk off for equity markets? And the next slide I'd like to show you is a charts actually shared by Mark Minervini. Right, so if we can go to the next slide. And Mark Minervini, I think a couple of days ago, pretty much shared this slide. And he shows here the chart of the Dow Jones Industrial Average, right? This is the Dow Jones Industrial Average. How it is pretty much close to all-time highs. However, if you look at the chart above it, the chart measures what technicians call market breadth, right? Market breadth simply means is that if your market is going at all-time highs, market breadth is an indicator of how much of the underlying stocks, take for example the Dow Jones, or take for example the Nasdaq. If the main index is at all-time highs, then the question now is how much of the components of that index are actually sharing that same characteristic, meaning they are also at all-time highs. And what we're seeing is that although at the surface, from a window shopping point of view, maganda yung harap, right? It looks like it's all-time highs. If you look under the hood, however, under the hood, you'll see that all-time highs are only shared by 1, 2, 3, maybe less than 10 issues in a basket of 100. Why? Because you'll see that this market has pretty much been led by the FANG, M, T, S stocks, right? N meaning FANG plus NVIDIA plus Tesla plus Microsoft plus maybe AMD to a certain extent. And what you will see is that although there are a lot of stocks that are at new all-time highs, you'll see here that a huge percentage of tech stocks are already below the 50-day line. Not only that, a big demographic percentage of the Nasdaq stocks are already below the 200-day line. And this is why precisely Mark said that when you look at the index, it's at an all-time high, but when you look at your portfolio, you feel like, why am I not performing as well? Why am I losing money when the index is at an all-time high? Why? Because hinahatak lang siya by a few handful of issues. And this has been the case over the last few months. And what I'd like to point out is that this weakness in breadth, while it is not a great timing indicator, has usually been a very good leading indicator for market weakness in equities over the medium term. So while obviously I wish I could give you a timing as to how will this manifest, but it seems like we might see some weakness come Q3, right? Somewhere there, maybe Q3, Q4, maybe during the second half of this year. And I think that is essentially what Bitcoin is trying to price in, or is trying to stay ahead of the curve, right? I won't go into the details as to why NASDAQ is selling off. If you guys would like to learn more about that, there's a series that we're doing right now, 101 Crypto Learning Insights and what we learned from the recent crash. Matt Flores can post the link there on the chat page, at least so you guys can read the chat there. But to give you the gist as to why NASDAQ stocks are taking a beating, is because one of the major themes that we're seeing this year for investors and traders alike is that we're seeing a rise in bond yields, right? And the number one chart that you want to look at for this is the TNX, letter TNX, which is essentially the 10-year bond yield. But more importantly, that is a reflection of inflation expectations, right? Which means that if that goes higher, then the market is essentially expecting inflation down the road. And bottom line is that inflation, when and if it comes, the worst that will be hit is the tech sector, because the tech sector is essentially very back-ended in its earnings and profits. A big chunk of its DCF comes from the terminal value, which is why when bond yields go higher, your discount rate goes higher, therefore your fair value goes down. I know that was a lot to consume, but if you would like to learn more about that, then just join the link. We will tackle it there in much simpler detail. So I've pretty much, it's 5:50. I apologize, I pretty much overstayed the time that I'm welcome here. So without further extension, I'd like to open the floor for some questions and answers. Right? But before some question and answers, just guys, we'd like to welcome you to just click the link that Matt is sending here in the comment section. I apologize, I don't have access to the chat, so I can't send it. But if you join that link, we'll show you more slides and more insights. So at least the focus now can be how can we prepare right now so that when the next bull market comes in crypto after this long sideways consolidation, then we can be very prepared for that. There was this nice quote that I heard Derrick Rose say last night after the Knicks game. He said he lives by 5 P's, which stand for proper preparation prevents poor performance, right? And now is really not the time to perform. Now is the time not to lose money. The time now is to really put in the preparation so that when the next bull market hits, you are prepared and you don't have to scramble left and right to see what you need to do to take advantage. So with that, guys, Joseph, let's open the floor for Q&A. I know we overstepped our time, so maybe we can extend. Kyle, is that okay if we extend maybe by 10 minutes, 5-10 minutes, 15 minutes max for some Q&A?
No problem. So thanks again, Avi and Joseph, for your presentation. I'll let you guys pick the questions. So everyone watching, go ahead, ask your questions. I'll be featuring them on the screen so that you guys can answer them.
So Destin asks, more coins na ba sa PDAX? We'll leave that to Kyle and his team and future announcements.
Yeah, very soon, guys. I won't say how soon, but very soon na lang. Ito lang, I think this is something I kept saying na very soon. But again, yung start with PDAX campaign natin, it's just a ongoing journey. So stay tuned. Who knows? Maybe June. No promises, but maybe June. Thanks. Go ahead.
Excited for that.
Yes, definitely.
There's a question here, Habs, if you have any insight from Rogelio about what can you say or any opinion. Hold on, I think the question disappeared. I can't find it.
About the Bitcoin Taproot upgrade. Ito ba?
Do you have anything to say about that, Kyle?
Personally, I haven't actually read too much recently about the Taproot upgrade, so I wouldn't be able to give much.
Yeah, Rogelio, my apologies. I can't say also much about that. Most of the work I've done, at least the past few weeks and months, has been on Ethereum EIP 1559 transition from proof of work to proof of stake. and the merge and the optimism and the arbitrum rollups. So, full disclosure, I don't have any Bitcoin, right? Open Journal knows this. We were very transparent about the stops that we had with respect to the I'm really more focused on Ethereum primarily because I do think Ethereum has a much larger upside than Bitcoin. That's one. If you just look at the ETH BTC chart, you'll see that you'll pretty much see it there that Ethereum is pretty much outpacing Bitcoin over the long term, even though that chart is correcting at least in the short term. And
I
even
get
if you look at the
yes.
fundamentals, the number of unique addresses is 113% in Ethereum versus 62% for Bitcoin. So I do think Bitcoin is going to go higher. I haven't really looked in the Taproot upgrade. That's something within the next 6 to 12 months. So my apologies for that.
Maybe related to this, Javi and Joseph, I'll bring up Marvin's question. Thoughts on Binance Smart Chain against Ethereum, and siguro you can like expound to ETH, quote unquote ETH killers, right? Like Cardano or Solana or Avalanche or Polkadot. So yeah, maybe you want to share.
You wanna take a stab first, Joseph, or do you want?
I'm sure you can go ahead, Tabs.
Right. So obviously there are a lot of questions there. So I'll really try my best to answer some of the things he asked for. But what you essentially asked are first generation protocols, right? Or let's not first generation is Bitcoin. Let's call what you asked for second generation protocols. These are the DeFi protocols, right? So you talked about Ethereum, you talked about ADA, you talked about Solana. And what we'll say is that if you simply look at it from a smart contracts point of view, if you look at the total market, right? The faraway leader really in terms of smart contracts is really Ethereum. So they have around 56%, around 50 to 60% of the total DeFi market in terms of total smart contracts. If you look at the next leader behind Ethereum, it's really Binance with around 20 plus percent, right? And I believe after Binance, I think the next market leader is I think around Solana, which is maybe around less than 10%. So just looking at that, you can see where the potential value can really accrue. Because not only does Ethereum get value when more and more developers start to develop, let's say, protocols on top of Ethereum, but let's say, what if a protocol on top of Ethereum gains adoption as well, such as let's say NFTs, or let's say then that value also accrues to Ethereum. So right now we're pretty much in terms of the DeFi space, we pretty much are only focused on, let's say, Ethereum, Binance, and to a certain extent Solana, only because the market cap is very low, let's say, compared to other issues like Cardano. If you look at Cardano, although the chart looks attractive, I will say that from a fundamental point of view, it's really the least attractive all of the out of all the platforms, simply because um, Cardano has really been, I mean, obviously prices are a reflection of 6 to 12 months down the road, but the rise in Cardano for me the last few months doesn't look justified to me, simply because they haven't really rolled out anything. There was an announcement that they do plan to roll out. I saw an announcement today that they're looking to roll out something, but I do think that they're still very far away versus, let's say, Ethereum versus, let's say, versus Ethereum versus Binance versus even Solana from an adoption point of view in terms of developer mindshare, right? They haven't really come out with anything, to be honest. If you look at the ecosystem of Ethereum, if you just Google Ethereum ecosystem, you'll see that they have two predominant components, DeFi and NFTs, right? Those are the biggest components. And under DeFi, you have DEXs, you have lending, you have liquidity aggregators, so on and so forth. If you Google Cardano ecosystem, all you'll see are universities, right? Like not exactly real world application protocols, but rather a community of universities that have potential, right? It's more potential. Potential. I mean, they did have this application, like they were developing this application, I think with New Balance, right? If I think that was a couple of months ago, where you could track I think it was some application on your exercise. Sorry, it was some application on New Balance. I really don't know the details, but that has been discontinued already, right? So until they're able to prove that they can walk the talk, then it's something that I will keep in the bucket of just, trading. I mean, and to be clear, I do trade Cardano, right? I mean, if you follow my public eToro account, you'll see me trade Cardano up 10%, I take profit, up 20%, I take profit, right? But it's not something that I would label as a bag that you can hodl long term, right? So that's something that so if you want to learn more about, and whoever asked the question, if you want to learn more about these DeFi generation protocols, the guy that you want to listen to is James Wang, right? Just Google, just find his YouTube. He's pretty much the number one Ethereum pimp, in my opinion, and he pretty much details there why Ethereum is where you want to be versus, let's say, Cardano, and how even Solana, which I think pre-crash was 6 billion, below 10 billion market cap, versus, let's say, something like Cardano, which was trading at a ridiculous 60 billion market cap before the crash. So, yeah, I mean, so that's pretty much my take with to answer your question. You mentioned Polkadot. Polkadot looks like a more promising project than Cardano. They have a lot of catching up to do. They do offer a unique interoperability USP, although that interoperability is already being offered by similar protocols that are already working with Ethereum to provide that same function. So, yeah, I hope I was able to answer your question.
No. Thank you, Javi. Go ahead, Joseph.
Sure. Is that the one about the shorting, right?
Yes.
Cool.
Do you suggest shorting while we are still not in the bull market?
Well, for me personally, I would say I wouldn't, simply because following where we are in the trend, this major correction is likely going to be choppy and volatile and extended over the next 6, maybe 9 months. I recognize that shorting, yes, you can make money. It can be used to hedge long positions. But at least in terms of the risk reward, in my opinion, given the grander bullish case for Bitcoin, Ethereum, and the space in general, it wouldn't be so attractive to me regarding the risk reward. And I personally also haven't had that much experience in shorting to be able to say that it would be an edge that I would carve towards. Because I also recognize when you're primarily long, but then you take shorts to hedge, it to an extent messes your psychology, and there's a large degree of dissonance, which I personally find challenging. Any additional build on that, Hubs?
Yeah, so I personally have a lot of experience in shorting. And what I'll do say is that, especially when we're in a public seminar like this, where the demographic is primarily people without any trading background or very minimal trading background, I would just really just discourage it, simply because having a lot of experience in shorting and going long I would characterize if investing or trading was a video game, shorting would be level 10 in terms of difficulty. It would be it's one of the hardest things to do, simply because number one, you have unlimited downside, right? If assuming you don't have stops in place, and not only that, from experience, kasi you have to understand that shorting is attractive because how markets work in general is that it's escalator up, elevator down, right? That's how markets work, right? And shorting looks attractive because elevator down means you can make a lot of money in a short period of time. However, if you look at if you look at the counter rallies that you'll see inside shorting, those are what I would characterize as rip-roaring counter rallies, which means that yung mga counter rallies inside the elevator down, they're very hard to deal with, right? In fact, and that's precisely why shorting is a lot harder holding on the way down than it is holding longs on the way up, right? So, generally speaking, that's why I would recommend shorting, especially in this kind of setting. Second is that the rule that we use is that if you want to go long the strongest issue. If you want to go short the strongest, go short the weakest issue, right? And the reality is that if you look at financial markets as a whole, post-COVID, right? And post-COVID, where we pretty much had the largest artificially pumped up markets due to stimulus, due to record stimulus, we're pretty much cryptocurrency, even after the crash, still remains to be the strongest market relative to equities, relative to emerging markets, relative to real estate, relative to even some of the weakest sectors, even the tech sector, which is small caps, which are even some parts of the sector which are currently taking a beating. So you want to go short the strongest issue, right? That's not something that we would recommend. Although what we would recommend, let's say, especially for advanced traders, is just trading the short-term moves. I think in Open Journal we did that a few days ago, where we pretty much where a lot of traders bought the low and pretty much sold the last few days already. So those are via some real-time updates that we have on our Discord channel. And so I wouldn't recommend shorting. If you want to make money, there are a lot of easier ways to make money than shorting a strong asset. Yes. So
Yep.
you'd rather go long Philippines or maybe wait for the next at least short-term leg up in crypto and just make money there, right? So I hope I answered your question, Mark.
All right, and I think this can be the last question we have for the webinar since it's almost 6:10 na rin. Feel free to answer either Avi or Joseph. No? You mentioned in the webinar that the main catalyst for Bitcoin is if it replaces gold as a store of value and Ethereum if adoption of its protocols increases. My question is, what are the main factors that can negatively affect both of them? Thank you, Jess, for that question.
Right. So maybe I'll clarify the question. Yes, you are correct that the main the main use case for Bitcoin, and there are many use cases that it can really go for. But I would say the lowest hanging fruit use case would be Bitcoin as a store of value. And just looking at gold, which is the primary tool for that, 5 trillion market versus Bitcoin 600 billion, then you can already see the potential to where Bitcoin and gold with just one use case versus multiple use cases. For Ethereum, the main catalyst or the main use case is really DeFi, decentralized finance. If you look at where majority of the TVL is coming from for Ethereum? It's coming from two use cases. It's DeFi and NFTs, right? Adoption of its protocols are simply an adoption. The adoptions are just the fastest for those two protocols. DeFi, where you have projects like Aave, Injective Protocol, and even projects like Rep USD or Augur, which is meant to replace the traditional bookies, right? So that's one use case. The other use case is NFT. And while I would say that the more bubble characteristics are present in NFT, that's not something that you're seeing in DeFi, which is really gaining in terms of total value lock, in terms of money flowing into the space, in terms of value flowing into the space. So how to be to clarify your first sentence. Your second sentence is, what are the main factors that can negatively affect both of them? Joseph, you wanna chime
Sure.
in here? Or yeah.
Yeah, I can chime in here. Thanks, Habs. Regarding certain factors like headwinds, which can affect this crypto thesis, meaning Bitcoin and Ethereum, I think there are two main things we should look at. So one would be TNX, or the yields, and hopefully they stay at bay so that it does not cause essentially risk off for risk assets, of which cryptocurrency is arguably a part of, and that could potentially burst this party we're having with crypto and definitely be a headwind moving forward. Simply because if yields go up your 10-year, and that is indicative of inflationary expectations, magiging risk-off po siya because people are now more incentivized to switch asset class and go there versus stay in risk assets. The second, in my opinion, will be weakness in the US market. So even though Habs was arguing and showing to us that cryptocurrency and Bitcoin could be a leading indicator for that, if we see a sharp correction or sell-off in the US market, that could definitely spook the financial markets across the world, and really by extension, a lot of asset classes and risk assets like crypto, as well as emerging markets like the Philippines.
Right. Thank you, Joseph. And we'll maybe end with me just piggybacking on what a point that Joseph made, and I'll highlight two other risks that we've been tracking. The first thing that Joseph said is higher bond yields, right? And the simple explanation of it is that the reason why higher bond yields are a risk to the system is because of the record amount of debt the system has accumulated over the last years. And obviously, part of the problem is really the Fed borrowing more and printing more money to fight COVID, right? So that essentially has long-term repercussions. And just to give you an example, if you look at the TNX, which is a reflection of inflation expectations, and this was a study showed by Stan Druckenmiller just this weekend, he said that if the 10-year TNX goes to 4.9%, and it's at 1.6 now, 1.5, that would bring total interest expenses of the US government to around 30% of GDP. That would essentially mean that if bond yields go up to 4.9 for around 4 something percent, that amount of interest burden is equivalent to the total amount of stimulus released by the US government for COVID since COVID started since March 2020, which is around 15 trillion. Right, which is somewhere around there, right? Which means that if you just jump that, then just the size of the debt alone will yield an interest burden which is equivalent to the total amount of stimulus released since COVID started, right? So that's one way to look at it. Another way to look at it is to just go back to the last time it happened, which was 2018. In 2018, it was the same thing. You had bond yields going higher, primarily because Jay Powell was on the path to tightening. And what happened? As soon as bond yields reached 3.2%, this was October 2018, the bond market couldn't take that level of interest anymore because of the sheer amount of debt in the system. And what happened? Financial conditions started to tighten, and the U.S. market, the S&P, from October 18 all the way to December 23, within 3 months, fell by 25%. And it was that particular instance that warranted Jerome Powell to do a 180-degree flip from tightening to now doing more QE, right? So if you look at what every smart money investor is looking at around the world, whether it's hedge funds, pension funds, investment funds, endowment funds, everyone's asking the question, at what level on the 10-year do we reach that serves as a breaking point for the financial system? And it's only logical to think that if in 2018 the breaking point was 3.2% before the market couldn't take it anymore, what more today when the debt has pretty much accelerated since COVID? So obviously no one knows what that level is. Is it obviously it's lower than 3.2? Is it 2.5? Is it 2.2? Is it 2%? Right? And if you're looking at what the Fed is doing now, the Fed is doing the best effort it can possibly do to pretty much, and the best way to really describe it is to play Jedi mind tricks on the market. There is no inflation. There is no inflation. Inflation is transitory. Inflation is transitory, right? When in fact you're seeing a lot of asset price inflation. You're seeing, let's say, I think we saw an inflation print of 4.9%, which was one of the highest that we've seen, and I think the figure was 11 years, simply because of the low base effect, right? Coming from April last year, which was the first COVID month coming from this year. And we're seeing another low base effect print again next month. And all the time, the Fed is saying, there's no inflation, it's transitory. Why? Because they're really trying to everything they can, from QE to forward guidance to all these press conference, which wasn't really present before, to really try to talk yields down, right? That's what they're trying to do. So that's pretty much the major risk that we're seeing, not just for cryptos, but for equity markets. So we're watching that closely, and it was actually a good sign that yields actually pulled back this week, although it seems like they are basing out before possibly making a leg higher. The other risk that we're looking at is obviously central banks, right? Because obviously what DeFi is trying to do is that they're trying to displace, or they're trying to disintermediate the current financial system at which is governed and controlled by central banks. And I think it was one of the best hedge fund managers who said, Diego Pararina, he said that don't be naive and think that central banks are not going to let this happen without doing something. Right? Don't be naive in thinking that they're just going to let cryptocurrencies happen, which essentially is trying to replace them as the technology for money. And that's precisely why we watch Fed speak and we watch what they say very closely, right? So you had Jerome Powell talk about Bitcoin. You had Vice Governor of China. You had 2 weeks ago, I think it was Brainard and Kaplan talk about Bitcoin. Those were the latest statements on cryptocurrency and Bitcoin in general. So what I will say is that versus 6 months ago, versus 12 months ago, the risk is much smaller because Fed people have come out and said that they don't really see it as a substitute for money or M2, meaning they don't really see it as a medium of exchange. But what they really do see is as a threat to gold, which serves as a store of value. So we're watching that very closely. And to the Fed's point, we're also looking at, obviously, you can't talk about risks without talking about CBDCs, right? Or central bank digital currencies. central bank digital currencies are the central bank's attempt to compete with cryptocurrencies. And you're seeing already that rollout, China being the first one. Powell early this year or during the last Fed press conference saying that they're not really in a hurry to get it out. They just want to get it right, right? That was his statement. And it seems like they might get it out by latter 2022. And to our opinion, it's really more a bigger risk to banks than it is to cryptocurrencies. Why? Because um, what the CBDC essentially does is that instead of having a current account or a savings account with a bank, like with let's say if you're a U.S. citizen, let's say with Wells Fargo or J.P. Morgan, right? You can now have a current account or savings account directly with the central bank. That's essentially one of the major changes that's going to happen over the next 6 to 12 months. And that's also precisely why, if you look at, let's say, Kathy Woods, right, who heads ARK Investments, she says that one of the 5 areas that will heavily be disrupted in the next decade are banks with a high branch count, right? And that's no surprise that even the Philippines, just look at the charts of Security Bank, Metro Bank, BPI, look at the 10-year charts, look at the double tops, the large head and shoulders pattern in Security Bank. Why? Because that's pretty much where the financial system is heading, where you can now open accounts directly with the central bank. And why are they doing that? It's because, and I'm going a little off track here, but just very quickly, is that for the longest time, central banks wanted to stimulate the economy. That's really their job. That's really their mandate, right? Obviously, it's employment and inflation, but I think it's been obvious the last 12 months that they've been trying to keep the economy, the stock market afloat, right? Primarily the U.S. central bank. And in order to do that, you need to control 2 things. You need to control money supply, M2, which is what they do, growing at 25% year on year. And the second thing which they do not control is money velocity, which has been going down significantly over the last 10, 20 years. Money velocity is a function of confidence, but it's more primarily driven by the banking sector. Why? Because QE, what the Fed is doing right now, QE, is really meant to encourage lending, encourage money velocity, encourage yung palitan ng kamay ng pera. But what the banks are doing is that they're not really doing that because they're risk off it. They're seeing all these, businesses that are having a hard time, so they're tightening their lending standards. So what CBDC is an attempt to do is it's an attempt to credit, let's say, your current account, savings account directly so that you can go out and spend that as opposed to going through the bank, right? So so that is inflationary in its sense. So I went way ahead of my skis as I always do. My apologies for that. But to answer, to at least circle back to the main question, what are the main, I think the Fed is something to watch out for and how it rolls out its central bank digital currencies and how that competes with cryptocurrencies in terms of what use cases they fight for, right? So that's one thing. Another thing lastly, another risk that we're watching out for is the China ban, which we do think has some teeth, simply because 55% of the hash rate of Bitcoin comes from China. It's pretty much for a decentralized protocol. It's pretty much centralized. The hash rate is centralized in China, particularly in Inner Mongolia, Central China, that area. So while there have been concrete rules that have already come out by the China government on how they want to ban crypto mining activities in China, there have been some positive developments, particularly on the Western side, in how the top American miners are not only trying to decentralize and spread out that hash rate even more, but to make sure that that hash rate or the power comes from more energy-friendly sources. In fact, there's a current meeting or conference that was held this week between top American miners and Elon Musk in order to convince him that most of the power driving the crypto mining came from renewable, and at least how to even increase that share moving forward. So those are the main factors that we're watching out for. Jess, I hope that answers your question.
Nice.
All right. I guess that's it for our time. Thank you so much, Javi and Joseph, again for your time and sharing your thoughts and really your insights into what's been happening so far and what do you see to happen in the coming weeks and months. So once more, if you would like to plug Open Journal, please do before we wrap up.
Right. So, guys, thank you once again for watching. We do sincerely appreciate all of you who took the time on a Friday afternoon. If you would like to learn more about cryptocurrency, we are coincidentally doing a series of posts now entitled 101 Crypto Learnings and what we learned from the recent crash. So data from the recent crash, like how much pretty much was wiped out, like 8 billion of losses, 775,000 accounts wiped out just using leverage, and what are the long-term prospects. We're doing 101 posts over the next few days, and whether you're into cryptocurrency or not, if you want to learn at least the basics about cryptocurrencies, that would be maybe the best way to do it. So maybe we can share the link one last time on the comment section for you guys to just click that, apply, and we'll auto add you to the community.
Yeah.
Right.
So it's also featured in the screen for your easy viewing as well. So for those
Right.
watching. Ayan.
Right.
So
thank you. And
thank you.
yeah.
Thanks, guys. That was good. Have a great weekend.
Have a great weekend, guys. And just a reminder, our giveaway is still ongoing. Have a chance to win a gaming bundle, an iPad Pro, or a vlogging set if you guys want to be an influencer of your own on YouTube. And thank you so much again, Javi and Joseph. We'll see you in the next one. And for everyone else, we'll see you next week for our weekly webinars. Until then, see you, everyone.
Thanks.
Right.
Welcome.
Thank you, guys.